Hello, how are you? In this video, we will cover the capital asset pricing model, and this, in short, it's called the CAPM. And this is the one of the model to calculate the required return on the equity, or in very simple layman term, if you want to see, okay, what's the required return on your share, that this formula will be very useful. There are some other models, for example, but I won't be able to cover in this video. I will focus heavily on the CAPM model. Okay, so in myself, okay, who are new to the channel, myself Pramod Kumar, I am a CFA charter holder and FRM certified, and I have my website as well. Okay, so without further delay, let's get started. So the formula for the required return on share, or we can say the equity, is the current expected risk-free return and the beta of the share times the equity risk-free premium. Okay, so don't worry, I'll use a lot of whiteboarding, and then I'll take the two share example, for example Tesla and Walmart, and then try to calculate the required return on a share for those two companies, right? But before I'll do that, I'll try to go on each component. For example, equity risk premium, how we can calculate it, what is meaning, what do you mean by the risk-free return, what do you mean by the beta of a share. And once we understand that, and then we'll plug the numbers, and which basically that's a simple, once you plug, you will get this the required return. Okay, so let's get started. Okay, so I'll have my full screen now to work. So now I'll little bit do more whiteboarding. So in order to save time, so basically what I will do, this risk-free return I will use as RFR annotation, right, to use it. Okay, and then for beta I will use the Greek letter as B, right, while showing in the whiteboard. Okay, so let's try to decompose this formula more, right, and then we'll go in each component, right? So let me write it down. So the required return on the share or the equity, right, it's nothing but, if I'll say RFR, risk-free rate of return, plus the beta of that share, if I represent that with I, which is mentioned here, right, I, times the expected return of the market minus the risk-free return, right? So this part of the component I break down into the two pieces. Okay, so now I'll start from this from this box, try to tell you what, and then we'll go from right to left. Okay, so first thing we very need to understand what is the risk-free rate or risk-free return, right? So risk-free return means risk-free return, in short RFR. When we refer to anything called risk-free, so first thing we refer to as that the entity who is providing that rate, or the instrument, any instrument, for example, when we say the instrument, we implies like a share or bonds and so on, right? So that should be risk-free, and risk-free mean it should not be default, so no default. So what do you mean by no default? So no default means if you put your money there for a certain rate, right, it should you should be worry free. This means you will get your principal amount, whatever the money you have invested, plus the return on that money. So it should not be default free. It should be no default or default free. And the second thing is, even if you have to make any reinvestment in that instrument, right, no reinvestment risk, that should be also default free. Okay, so that kind of a rate. So if you let's say you put you have a investment horizon for 1 year, you invest 6 months, and then if you get some return, let's say some kind of a money back in terms of interest, and if you put that interest money back to that instrument, that is also investment is called risk free, no reinvestment risk. Okay, so that's pretty much it. So since in this video I'll show you the Tesla and Walmart, which is a ticker name for Tesla and Walmart company, TSLA and Walmart, to compute their required return. And these are the US based companies. So in US, if you want to get the risk-free rate of return for that company national, so best is to take that's the treasury rate, right? Because treasury rate assume virtually these are almost these are the default free, at least for now. Okay, so we assume these rates are, because the rates are going low, is 2% based on our investment horizon. Okay, so the next thing is, so we take this one, right? So the next thing is we have expected risk return on the market. So when we say the expected return on the market, we take the broad-based index on the market. So in US, the broad-based very famous index is S&P 500, right? Which is the broad equity market index, right? So what's the return on that market return, right? So usually it's give on average historically 10%, let's say the 10% return, right? So we assume that is 10%. Maybe it's a little bit up and down, but we from our equation we'll assume that 10%. Okay, so this is the second component, this one. The third component is the beta. So beta is what is, right, is the risk, market risk, or the systematic risk. So beta of the broad-based index is 1. Okay, so if beta of 1, and in relation, so basically what beta is saying, how this company how much company has the market exposure, right? Or market exposure. So right, so if I say in relation to the market, so let's assume if my market is going like this is for my beta 1. Okay, and if my Tesla has as I know it has a little bit more risk here, so let's say its beta is little bit over 1.2 or something, then this beta will travel over to the market, something like this, right? At the same time, if we assume the beta of the Walmart is, let's say, 0.31, okay, and actually this is 1.21, right, like this one. So this will be very low, right? It's behave very low because it has very low market risk, right? So that's for the Walmart, and I'll show you how to get that beta as well. And this is 1.21. okay, this is Tesla. So now we have all the component available what we need. Okay, so now if you want to compute the required rate of return, so let me show it to you as well. Okay, so I'll take the fresh slide. So let's take the Tesla. Okay, so here I will use I'll write the formula just for the sake of easy. I hope you remember this formula. It's pretty straightforward actually. Minus risk-free rate. This is the market, right? So the risk-free rate, we have 2%, right? Plus beta of the Tesla. Okay, let me take the precise beta. Okay, So the beta of Walmart, as you can see, is 1.31. Let me write it down, 0.31. And if I can, here is the beta of 5-year monthly, right? If I can take the Tesla, which is around 1.17, okay? So 1.17. Okay, so let's plug our number back. So this is 1.17. This we assume is 10% on based on historically, minus 2% back. Okay, so how much it is? Okay, so let's calculate. So this one should be 2% plus 1.17. This is 8%. So if I solve this, let me take my calculator. So 8 times 1.17 plus 2. So this come as 11.36%. Okay, so this means this company return must be must able to provide this. This is the required return on the equity, right, for this Tesla company. But at the same time, if I want to go to the Walmart and I'd say, okay, so the formula is pretty straightforward, right? So 2% plus 0.31, 10% minus 2%. I know this is same if you, this is 2% plus 0.31 time 8%. So let's calculate what it is. 8 times 0.31 plus 2 is only 4.48%. You see? So the required return on the Walmart is way low as compared to the Tesla. So now this required return, so basically this is on the US equity, right? Similarly, if you want to calculate on your country, depend whichever country, you take your country broad-based index, just replace with that one, replace that this number. Let me highlight with a different color, right? So it's easy to understand. Yeah, so basically this is the required return of the broad-based index, right? In US, it is S&P 500. If we see in your country, it may be different. The beta is the share beta, right? You can easily get from Yahoo Finance, and similarly, I believe, depend upon your country, you can easily get that as well. Otherwise, it's not hard to calculate, honestly. I can make a video if you want, just put in the comments. And the risk-free return is your government risk-free return, right? Most of the developed country risk-free return, basically the company is risk-free rate, right? If it's issued by the company, depend if they have the AAA ratings and all, right? So, but I don't want to go into that much detail, but that's pretty much here is it, right? And the rest is just plug and play this number, and we can see in our example the Tesla and Walmart, right? Now this is the required return we get. So now the usage of this is to one more usage on this one. Not only this is giving me the required return on the equity, okay? So the cost, this is the one cost for the company, right? But there are other costs to the company as well, which is the cost in terms of the bonds, right? How much bonds they issue. They also has preferred dividend, right? So this formula goes to the WACC, right? Right. Wait. Oh, I have to switch to the pen again. Sorry. Just a minute. I'm almost done with this video. Yeah. So this formula is basically used in the WACC, which is weighted average cost of capital, right? And as we know, maybe if I'll cover, if you want me to cover in some next video, that this in the cost of the company includes when if they have a bonds, right? Bonds plus we get this equity, and then it's basically takes some weights on these and try to compute the total cost of for the company, right? Weighted average cost of capital. That's how this formula is. So that's pretty much on this video, and I do have some other video on the stock analysis. If you like it, kindly do subscribe to my channel and like it. And if you want me to cover any particular topic, please put it and I'll in the comments, and I'll try to make a video on that one. And thanks for now, and thanks for watching. Bye for now.